Pull the trigger.
How's it, traders, and welcome back to Paradime Flip. Hope you're all doing well. In this video, I just want to cover a few things. Last week on the 2nd of February, I sent a post to my trading community indicating that I was anticipating sells in the very near future on the S&P 500. And you'll see that post basically says that buyers should be cautious. And I saw a lot of factors lining up that indicated that there was a very high probability that we can expect selling to come in. And if we just go into that post, you'll notice that I have an arrow right at the top of the candle that was forming on the 2nd of February, indicating that I was expecting that candle to be the high of the market. And indeed, it was the high. Now, if we just go into the S&P 500, right, what I want to do is just outline some of those things that led me to believe that we can anticipate sells, and hopefully you can gain some information and insight from these teachings, and you can hopefully apply them in your own trading. But before we get into the content, I just want to quickly take the time to let you guys know that I have now updated my tiers on Patreon. I have two tiers. My first tier includes the Paradigm Flip Price Action Mastery course content. In this tier, you can expect to get my course and learn my trading style and techniques. The videos in this tier will be updated periodically, so as long as you are a subscriber, you'll have access to these. My second tier not only involves the course content, but it also involves a hands-on mentorship experience with me, where I basically take my time to help you connect the dots, guide you, and show you how to put everything together. This will obviously increase your learning curve and shorten your learning time. Now, my first tier is actually designed to be affordable for most. For the price that you would probably spend on a weekend, you can simply take that money and invest it in your own trading education, even if it is just to test the waters, if you wish to do so. Right, so without wasting any time, let's get into the video. So here we are on the S&P 500 on a daily chart, and you'll notice that candle on the 2nd of February, right, where I had marked a arrow on top, and you can see that candle closed with a wick, right? Now the first indication that I got that we can expect selling to come in, right, was the fact that we had run the stops of this previous high. And whenever we get a stop run, you can expect profit taking. Okay, it's something that's very simple, right? And it occurs very frequently, right? Whenever we break a previous high, you can expect that stops are run, right? And anyone who was buying in this move, right, you can expect them to take some sort of profit. Okay, and that's one of the first points that I was looking at, right? And it's the foundation that allows me to believe that, okay, so we have run the stops, so we can expect profit taking. That means that there is going to be some sort of fuel that can fuel a downside move, right? The profit taking can fuel a move to the downside. Okay, and that's basically the framework for the trade, right? But we want to go deeper and get into the nitty-gritties and figure out what actually led me to believe that the market would sell off, right? Because at the end of the day, we want to stack odds in our favor, and every bit of information that we can add to this picture, we can draw up a narrative, and that's going to increase our odds greatly. So the first thing that we're going to do is that we're going to go to the VIX, right, the S&P Volatility Index, and you'll notice that the VIX, if I just zoom out of here, right, is near a bottom edge, right, and if I just bring this pink line up, right, you'll notice that we are at the bottom of a range. Now the VIX is a range bound kind of market, right, and very mean reverty. So you'll notice that every time we reach a bottom edge, we tend to go to the top of the range, and every time we reach the top of the range, we end up at the bottom of the range, and vice versa, right? And we find ourselves at the bottom of the range once again. Okay, so we can expect that move higher on the VIX, right? And I've covered this in previous videos, right? So I'm not going to get too much into it, but the VIX is very correlated, negatively correlated with the S&P 500. So if the VIX index goes higher, right, we can expect the S&P 500 to drop, right? And because we are at the bottom of the range on the VIX index, right, we can expect a move higher or a bounce, right, on the volatility index, right, and that'll cause a sell side move on the S&P 500. Now, it's important to note that volatility normally clusters to the downside, right? So whenever we are at a low volatility area, right, we normally get a lot of clustering, right? Whereas when we get a high VIX, right, we get very sharp moves back down. Okay, you'll notice that when we spike up, we get very sharp moves back down, right? So it's better to predict the move, right, when we are at the top of the range, and it becomes a bit more difficult when we are at the bottom of the range, right? Because volatility can cluster around this area before moving back higher, right? And that can cause S&P 500, right? If S&P 500 is negatively correlated with the volatility index, that can mean that S&P 500 can basically have a bit of a trend going higher, right? While we are still at the bottom of the range, okay? And eventually break to the downside if VIX trends to the upside, right? So we could, if we do get a cluster, right, on the VIX index at this bottom edge, right, it could cause a range, right? But nonetheless, a range on the S&P 500, but nonetheless, it will struggle to trade higher, right? And that's still good enough to anticipate contrarian trading coming in on the S&P 500, right? We can sell top edges, right, anticipating that it will either range or continue to drop, right? So if we play the top edges, right, you'll be in a good position, okay? But that's neither here nor there. That's just a bit of extra information, right, to keep in mind, all right? But nothing too serious to worry about at this moment, okay? So the main thing is that we do have the volatility index at the bottom of the range, and we can expect some buying action on the VIX, right? And buying on the VIX, right, no matter how small it is, right, will lead to selling coming in on the S&P 500. Okay, right. So that was the first thing that I looked at. Okay, now the second thing that I looked at, if we just go back to the S&P 500, right, was the correlation with the dollar, right? As the dollar is negatively correlated with the S&P 500 due to the current global economic conditions, right? The Federal Reserve is raising interest rates, and that's basically putting pressure on the S&P 500, as well as increasing the value of the dollar, right? So that is causing a negative correlation in the S&P 500 with and the dollar index. So we can actually just take a look at the dollar and have a look at what the dollar is doing to gain some insight into what we can expect from the S&P 500, right? And just to prove this, we can actually show the correlation coefficient of the dollar and the S&P 500. So at the bottom of the screen here, I got a correlation coefficient, and you'll notice that we have DXY typed in here, right? And the length is 20 periods, okay? And you'll notice that over the past few months, we've had a very strong negative correlation between the dollar and the S&P 500. And if I just put the dollar index overlaid over the S&P 500, you'll notice that is true, right? Now, what we have on here is the dollar index inverted, right? So I'm just gonna pin it to a new scale, right? Make sure that it's not inverted, right? And we can see that there is a very strong negative correlation between the dollar and the S&P 500, right? Whenever we get a rally in the S&P 500, the dollar is dropping, and vice versa. Whenever we get a rally in the dollar, right, the S&P 500 is dropping. Okay, and then something really interesting happened on the 2nd of February that led me to believe that the S&P 500 would sell off, right? And because this is a negative correlation, what we just want to do is we want to flip it around so that it can be positively correlated with the S&P 500. Okay, And you'll notice if we just zoom into this, right, and I just reset the scale, right, you will notice that on the 2nd of February, you'll notice that the dollar index rallied, right? So basically, because this chart is inverted, right, we can see that it's going down while S&P 500 is going up. And what we can actually do for ease, right, just for ease of understanding, we can just simply put Euro USD on the chart, right? So this green line, right, that we are looking at is simply the Euro US dollar, right? And we're putting it in a placeholder of the DXY, right? And if I just put the Euro USD into the correlation coefficient, right, you'll notice that the Euro USD is actually positively correlated with the S&P 500. Okay, and on the 2nd of February, right, you'll notice that the Euro US dollar was dropping, right, while the S&P 500 was rallying higher on that candle, right? And you'll notice that the candle ended up trading off its high, right, and creating a wick. Okay, so the fact that the Euro US dollar was dropping at a point where the S&P 500 was rallying, right? That let me know that I can anticipate sells to come in on the S&P 500, because for whatever fundamental reason the Euro USD is dropping, I can also anticipate that same reason to cause the S&P 500 to drop as well, right? And in this situation, the S&P 500 was lagging behind, right? So it gave an opportunity for sellers, right, who could see this opportunity, right, to then come in and short the S&P 500, right? And the last reason, right, if I just take Euro USD off the chart, right, was looking at the put call ratio, right? So this is basically the ratio of puts to calls, right, in the S&P 500. And if I just put this on a new scale below, right, if I just move this to a new pane and just move this lower, right, and we zoom out a little, you will notice that this is a very range bounding market or indicator, right? And what this is basically doing, it's giving you the ratio of puts to calls, right? So when we are at the bottom of the range in this area, right, this is an area where there are more calls in the markets to puts, right? So this is an area where the puts compared to the calls, the ratio of puts to calls is very low, right? And if we are at the range high, this is an area where there are more puts than calls, or the put to call ratio is very high, right? And when we are at the extreme or bottom edge of the put call ratio range, right, this is an indicator that we have more calls within the market, right, and less traders are hedged, right? So if you are trading the S&P 500, right, and you are long the S&P 500, and you are a large fund, right, you are going to want to have puts to protect yourself against any risk or downside risk. Okay, so if the market does drop, right, those puts are basically going to protect you, those put options. And if the ratio of puts to calls is very low, that means not a lot of people are actually protected and hedged to the downside, right? So it means that more traders are long than short at this current point, and there's not a lot of downside protection, right? So if the market does start to sell off, right, a lot of those traders who are long, or the unhedged traders who are long, are basically gonna exit their positions very quickly, and that's gonna cause a cascading to the downside, right? So and that will add to the pressure, the selling pressure within the market, right? Whereas if, for example, we were at this current top edge and the put call ratio was not at an extreme low, right? That would be an indication that we have a lot of puts within the market, right? And that any buyers coming in, most of them are most likely hedged. So if the market does drop, right, those buy positions are protected, right? So that means they are not going to be as paranoid about the market selling off. Okay, so if the market does pull back, right, they're not going to rush and sell. Okay, and that's not going to affect the market as badly as if we were in this situation. So in this situation, there's a higher chance of a cascading effect, right, occurring around this area. Okay, and you can simply see that within the history, right? Whenever we reach the extreme low of the range, right, we can expect the markets to sell off, right? Whenever we reach these extreme areas, right, you can expect some sort of selling to come in. Okay, right? We can look at this area here. Okay, you can see that very clearly, right? You can see that very clearly. And the opposite is obviously true, right? When we reach an extreme high of the range, right, you can expect some buying to come in. Okay, right? This whole area was just a cluster, right? And you can see that buying coming in there, right, in this area. Okay, so very important indicator that you can utilize there. Okay, and what we can actually do now is actually just simply go to the lower time frame chart and actually see how we can actually take advantage of these situations. Okay, so I'm going to head over to a 30-minute chart, right? And we're going to have a look at that area and see how we can actually look at these trades. Okay, so you will notice that this was the 2nd of February and you can see that the S&P 500 rallied, right? And if I just overlay Euro USD on the chart, you'll notice that the Euro USD started to tank from around this point, and we basically dropped on Euro USD the whole day, right? And at the same time, the S&P 500 was rallying, right? But because the Euro USD was dropping, you could have anticipated selling to come in on the S&P 500, right? And it did come in towards the end of the day, right? This might be a difficult trade for you guys to catch, right? Especially if you weren't looking at your charts at this time of the day. Okay. However, we did get that drop. Okay. And you could possibly anticipate selling the next day, right? Coming into the next day just by watching the Euro USD, right, as an indicator for trade direction, right? Now you'll notice after we closed, right, we formed that pin bar, right, and we're coming into the next day, right? And what we can actually do is just go to a lower time frame so we can see a bit more detail. Okay, right, and here we are on a lower time frame, and what you'll notice if I just zoom in here, right, we've got that area there. We can see S&P 500 dropping, right, and after the Euro USD dropped, right, and coming into the new day, you can see S&P 500 sold off, but Euro USD rallied a little bit, and the S&P 500 followed suit, right? It lagged behind once again, okay, and you can see they both dropped together at the same time around the non-farm payroll time, right? And that was this candle over here. Okay, after that the S&P 500 rallied. Okay, but notice that the S&P 500 rallied, but the Euro USD did not, right? The Euro USD is dropping like a stone, okay? And this was an indication that you could sell the S&P 500, right? Once you see the space between the two, okay? Is the Euro USD is dropping, you can expect S&P 500 to also drop and follow suit because these two are fundamentally correlating, okay? From a macro fundamental perspective, right? So if the Euro USD drops, right, we can also anticipate and expect the S&P 500 to drop, right? Now it doesn't drop immediately, okay? But once you see this happening, right, once you see Euro USD dropping and the S&P 500 rallying, you can anticipate those sells to come in on the S&P 500. Now it will be up to you, right? This basically gives you your trade direction, and then it will be up to you uh, to find your levels, right, where you want to start dealing and making your entries, right? And how I like to do that is I basically like to have a look at the volume, right, profile coming in from the previous day, okay? Right, so if I just draw a volume profile of the previous day just to understand where the buyers and sellers were mostly located within that day. And you'll notice that we have a couple of volume nodes here, right? We have this volume node here, right? And we have this volume node here, right? And that was the area that sold off, right? Okay. And we have this volume node here, right? Now, after the market starts to rally, right, and we trade into this volume, this is an area where we previously had a lot of two-way money, okay? And we can expect some activity to take place in this area, and we can expect sellers to come in around this area, right? And you can see when we trade into this level, okay, we do indeed see some selling. Now, your first clue would be price rejecting this area, right? You can see as we trade above a previous high while we are in this area, we get that strong rejection, right? That's a sign of selling coming in, okay? And you can see around about that time, the Euro USD is still tanking, right? And then we get a pullback, right? After that, right, we get this pullback into the range, right, and back into the volume node, right? And the S&P 500 at that point is still dropping, okay? So that would be another area where you can sell into, okay? And you can basically take your entries on a lower time frame, right? Looking at the lower time frame structure, right? You can basically see that we basically have this head and shoulders patterns. If you're a pattern trader, right, we have this basic head and shoulders pattern, right? You can see there is a break of structure here, right, and a pullback into the structure, right, where you could have taken your trade setup in this area here, or possibly on a reversal bar, right? If you're looking for confirmation, right? If you're a Quasimodo trader, right? That's a very popular pattern that traders look at, right? This was basically a Quasimodo pattern setup. And it doesn't matter how you look at it, what you're trying to do is just look for a technical pattern that confirms the entry criteria, right? In the direction of the confirmed bias, okay, that you have obtained obviously from looking at the Euro USD, right, and a number of other factors, right. You'll be anticipating these sells, okay, and you have come into a level and you get a technical pattern that you can then enter a low risk, high reward trade setup, right? So what you actually have here is a number of confluences that come together that give you a high probability, low risk, high reward trade, right? And you can then go and apply this to your own trading. And this technique is not only used on the S&P 500, right? You can use correlation analysis on any of your any of the pairs that you trade, right? And it's a very important and valuable tool that will definitely increase your probability and trading success. Now, I hope you learned from this video and I hope it adds value. And if it did, please make sure that you leave a like and a comment. Please subscribe for future content. And I greatly appreciate your time and efforts being here. And until next time, I'll catch you all on the flip side.